Hey friends, I'm excited because I have only about 6 years left on this journey towards my goal of passive income from dividends. As I only have about 6 years left, I shared this by the way in my last video, which I'll link to in the pinned comment below. I'm starting to look critically at my portfolio and I'm starting to realize, hey Ian, you can buy some higher yielding stocks right now to accelerate this dream, to reach this dream even quicker. And so when I'm buying dividend stocks, I always try to kind of balance current yield with future dividend growth. But right now at this phase in my journey, I'm starting to look a little bit more towards those high yielders. So many of you know I have ancillary positions in my portfolio. And a lot of these ancillary positions I don't look at all the time, but there have been a few that have caught my attention recently because they have fallen in share price, creating wonderful, amazing starting yields. I want to share in the video today kind of a hidden gem stock within my own personal dividend portfolio. I have not looked at this stock for a while. I bought a tranche of it recently this week after analyzing it, and this is a stock now that's yielding over 5%. And it's over 5% on a qualified dividend basis, which is important for my own situation. Now, my overall dividend stock portfolio on a current yield basis, not yield on cost, but just current starting yield, it's at 3.71%. And as you know, I'm investing heavily these days in SCHD, which starts at a 3.8% yield. Now, if I can sprinkle in some dividend stocks that yield 5% or more into the mix, right now, it really helps accelerate what I'm doing because of where I am in my journey. So I want to discuss with all of you today a stock I have not mentioned for years, although some of you in the community have reached out and asked me about it. Thank you. I always appreciate all the comments and all of the engagement on social media and here on YouTube. But the stock, I'm just going to get right to it. You got to check this out. It's Campbell's Soup Company, now called the Campbell's Company, I believe, CPB. They own Rouse now, Rouse tomato sauce here that a lot of us like to use in pasta and other dishes. This can be purchased in bulk at Costco, by the way, but this is a great product. They acquired this company recently back in 2024. I think it was called like Sovos Brands, and the biggest winner from that portfolio is Rouse. And so this is good stuff here. And I'm pleased to announce that it's now part of the Campbell's Company. But I want to go through this stock today and share why I'm buying it right now in 2025. As you can see on the screen in front of you right now, this stock has fallen in share price. It's fallen quite a bit. It's 42% off its 52-week high. I'm going to get into that later. There's some risk factors. Of course, I always like to buy high quality companies that are facing some challenges that have caused a value situation to appear in the stock price, but I think they can overcome those challenges and they are more than priced into the current valuation. That's how I like to invest. I'm a contrarian investor. But as you can see on the screen, check it out. So they're down 42% from the 52-week high. Based on the forward earnings estimates, which are $2.94 this year, $2.88 next year, you can see on a bottom line EPS standpoint, they're slightly shrinking right now. They're going through a period of transition, but nonetheless, the forward PE is in the 10s. Paying a forward PE in the 10s for world-class brands like Campbell's Soup, Goldfish, Pepperidge Farms, Rouse tomato sauce, kettle chips, so on and so forth, to me is something that makes a lot of sense. Anyway, the dividend per quarter is 39 cents or $1.56 a year. The starting yield is 5.1%. Now, that 5.1% is even more impressive to me because the payout ratio is only 53%. And I'll look at it later, but their statement of cash flows clearly shows, to me at least, that they can handsomely cover this dividend. They don't have problems with it from a cash flows standpoint either. So what does that mean? They're growing the dividend at 2.2% per year on average, although the dividend increases with Campbell's can be a little more haphazard, but I'll take it. 5% starting yield with some growth is great for me where I am in my journey right now, and that's a qualified dividend. Market cap is under 10 billion, just under $10 billion, and so it's a smaller company. And one thing to keep in mind with the Campbell's company is, could it be a acquisition target? That is possible. I don't really hope it is. I'd like to just hold this one and enjoy the current yield and use that yield to help pay bills. It's an ancillary position that is less than 1% of my portfolio, so it's a really small. I have room to grow this position, but it may or may not be an acquisition target. It's kind of small, and I think the valuation is really decent at this point. But I want to keep going. As you can see on the screen in front of you right now, I have in my dividend portfolio right now, I'm growing my cash flow, and I'm doing it three ways: via net new capital, dividend reinvestment, and dividend increases, and just time, waiting it out, waiting the snowball out. But anyway, under category one, net new capital, I can put that net new capital into a dividend growth stock or ETF, or a stock like this that offers current yield but lesser dividend growth. By sprinkling into my portfolio, not going all out, but including it in the mix, stocks like this, it can help boost my portfolio yield right now, which is meaningful to me on this home stretch. So I ran some calculations that I want to share with all of you. I want to compare Campbell's Soup to SCHD and just show to all of you why I like including stocks like this in the portfolio and why I believe for me right now this is a decent opportunity. As you can see on the screen in front of you right now, on the top of it all, I show just my portfolio. I'm aspiring to basically double over the course of the next 6 years my cash flow, and I need to grow my dividends about 13% per year. On the last quarter, I'm up about 2.5%. So if I annualize that, I'm at about 10% cash flow growth per year right now. Although on the back half of this year, I expect to amp that up with some additional capital contributions. Long story short, I think the 13% per year cash flow growth is possible, and that will get me after 6 years to where I need to be for my goals. So, as you can see below that, I can invest in SCHD or Campbell's Soup. I'm actually investing mostly in SCHD these days, but I am including some selections like Campbell's company in the mix. SCHD is growing the dividend on average by about 10%. You can see right now from a starting yield standpoint, it's at 3.8%. But over the course of 6 full years, that would come in the beginning of year 7 to 6.73%. Why is that? Because it's compounding over time at 10%. I'm not even including reinvested dividends in this formula. That would balloon this even greater. On the right-hand side of the screen, you can see Campbell's Soup. Well, they're growing at about 2.2% per year. And so you can see it's really in year 5 that they reach parity. And given that I only have about 6 years left, you can see here why including something like Campbell's Soup in my portfolio right now may make a little sense, just because it will take time for SCHD's yield on cost. I'm not even including reinvestment here, of course. That would alter this formula, but just for the sake of simplicity, I'm including the simple dividend compounding here, assuming I take my dividends out and just spend them. It takes about 5 years to get parity. 5 years where I'm at right now in my journey is a lot of time. And honestly, 5-6 years, I plan to be mostly done with this journey. Now, will I quit my job at that time? No, I'm going to keep working, but I'm going to be living my dreams and my best life. I'm going to reach my goals. But anyway, that's how it kind of works it out. But I want to go a little bit further on this analysis. As you can see on the screen, check it out on the bottom. So I don't actually think the past performance is going to hold up. I think SCHD is probably going to slow down in their dividend growth, maybe Campbell's Soup too. So here in this analysis, I'm showing 7% per year dividend growth at SCHD and 1% per year in Campbell's company. Basically, it takes about 5 years now for them to reach parity. It's really at the beginning of year 6 now that SCHD is at 5.33% yield on cost, and Campbell's company is at 5.36% yield on cost. And so this is really just the difference between dividend growth investing and current yield investing. For those people, investors who are closer to the end of their journey or who are maybe even living on cash flow, sometimes it makes sense to include some of these higher yielders in the portfolio. But for those that have more time to spare and can let the compounding happen for longer, oftentimes dividend growth is the way to go. For my personal situation, I like to sprinkle both into the portfolio. And honestly, I think these models can completely break down if there's a wild card scenario where SCHD is growing the dividend slower, say 5 to 7% per year on average, and Campbell's can kind of keep up their 2%, it would take even more time for parity to be reached. Anyway, I want to share some more thoughts. So as you can see on the screen right now, what I want to do is include some analysis of these financials from Campbell's Soup. So what you see here are the latest quarterly results from Fiscal Q3 2025. At a top line, I feel good about this company because the net sales are growing year over year, slowly, but they're growing. One thing I do want to point out that you don't see on this slide right now are the adjusted EPS of 73 cents. That's slightly down, to my understanding, from the year before. So this is a company right now that is facing a good landscape at the top line, but on the bottom line, the EPS is shrinking, but it's not too bad. They can clearly cover their dividend, and we already saw that on the payout ratio, but I want to get into it in the next few slides as well. So next, though, as you can see on the screen right now, is the balance sheet. I like the balance sheet from Campbell's company, and you can see that they have a good amount of current assets of $2.2 billion, and that's up from the year ago. And you can see total assets of about $14.8 billion. You can see that long-term debt is about $6.097 billion. It's up from the year prior, probably because of the Sovos acquisition. And you can see overall that the total debt for the company is $6.896 billion, and that's actually down year over year. So they're managing their debt okay. And you can see that the shareholders' equity, or the book value, if you will, is about $3.8 billion. I would say overall, when I look at that balance sheet, I'm fine with it. I don't see any major red flags there. Now, moving on, I want to look at cash flows because can they support this dividend? Just because the payout ratio is really good, let's look at cash flows to understand where the money is going and if they are getting over levered in a bunch of CapEx, for example. As you can see on the screen, check it out. And so right now, we can see that the net cash provided by operating activities is $872 million in the 9 months ended April 27th, 2025. It's down slightly from the prior year, but still very strong. And you can see there, if we scroll down on this page a little bit more, the dividends are $343 million. And so the cash provided by operating activities is more than enough to cover those dividends and the other cash outflows used for financing. In fact, when we look at the bottom of this screen, cash and cash equivalents at the end of the period, you can see that it went up. So this is a company, even after paying all of their dividends, they actually increased the cash that they have at the company by a good amount there. So we went from 107 million to 143 million. And so I don't see any major issues here on the cash flows, and it doesn't look like they're taking on debt or running into troubles covering the dividend. And they've been pretty conservative increasing the dividend over time. So again, I don't see problems with them paying the dividend. And I see value with this company for my personal situation. Now, it must be pointed out, is this the kind of stock that is going to make me rich overnight or any investor? No. Is this the kind of stock that is some kind of huge growth opportunity moving forward? No. But I see a solid starting yield. I see some dividend growth, and I think the stock price is undervalued, and I think it's a turnaround story. Yes, the bottom line is not growing right now, but the top line is doing just fine. They made a solid acquisition. They have great brands, and I think over time, the bottom line will grow once again, and they'll be able to support some future dividend increases. Now, this company does come with a few risks. As you can see on the screen in front of you right now, I outlined some of them right here. So, they have a lawsuit risk. There's some alleged Lake Erie pollution from one of their plants that they were using to manufacture Campbell's soup products. And so there's that risk. There's tariff risk. Tariffs are impacting their bottom line. And so that's one of the issues behind their earnings being a little slow to grow. And I believe there are snack food business risk here. This affects most snack food companies because of the GLP-1 drugs that consumers are taking that are suppressing their appetites to eat these types of foods. That being said, PepsiCo stock, one that I own, one of my core stocks that I've been buying, was up a lot today because the company once again is showing promise towards future growth. I haven't even digested the press release or looked at it yet. I just read the headline and I think the earnings were good and the stock is surging in price once again. And so that's something I want to remind myself of as well, that these turnaround opportunities, these value opportunities, the value doesn't last forever. Sooner or later, the market will figure out that once again, Campbell's will be fine as well. What is my thesis with this thing? As you can see on the screen, here it is in a consolidated fashion. So the thesis is, hey, the dividend is covered. The starting yield is solid for me as a qualified dividend. The PE ratio reflects risks at the company and their lack of growth. But I think it adequately reflects that. I don't think it needs to go on more of a discount than this. But of course, if the PE drops below current levels, I'm a buyer at a PE of 10 or below. I'm overweight CPG food, but this is the value the market is providing me right now. This will always be an ancillary position, but all of the ancillary positions added up play important roles in the portfolio. Top line growth seems fine, balance sheet seems fine, cash flows seems fine. It's a discount value stock investment, which is the bread and butter of how I have won and succeeded as a dividend investor over the years. You may remember not that long ago, I was discussing PepsiCo. The stock is now rebounding. Not that long ago, I was discussing Pfizer. I'm still buying Pfizer. The stock is now rebounding. A little longer ago, I was talking about British American, ticker BTI. That stock has absolutely surged since I bought it. A little bit of a while ago, I was covering Altria. That stock has absolutely surged. And now I am highlighting some of my wins here. Of course, I'm a regular investor like everyone else watching. My journey has been full of wins and setbacks. But what I'm trying to illustrate here, when I reflect back at what I'm good at, it is buying these types of turnaround situations on sale that provide a starting yield that is meaningful to my goals of reaching that dream state, which I'm trying to do in about 6 years or less. And that's the stock for today. So please click the like button if you enjoyed the video. Put in the comments below what you think about this stock. And I can't wait to hear from you. Of course, please don't forget to subscribe. And before I go, just a friendly note. I'm over on an app called Blossom. I'll link in the pinned comment below. That's my affiliate link. In terms of full disclosure, I'm compensated for signups. It's free to use Blossom, free to sign up, and they offer a premium version as well. I'm over there. This is the social media platform for investors, and there's a massive number of dividend investors over there, and I will be speaking at their flagship conference in Toronto soon. I cannot wait. So just check it out. I can't wait to see you all over there. Before I leave today, in terms of a full disclosure, I own the stocks mentioned today. I am long SCHD, which is an ETF. I'm long Campbell's company, CPB. I'm long PepsiCo, ticker PEP. I am also long Pfizer, ticker PFE. I'm long Altria, ticker MO. I'm long British American, ticker BTI. I'm also long Blossom. I own those positions in my personal dividend stock portfolio. Before I go today, in terms of a friendly disclaimer, today's video, it is not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Before you invest or make any financial decisions, please consult your licensed financial advisor first. I'm just sharing my journey for fun and entertainment. Thank you everyone for watching. I appreciate all of you. I can't wait to see you in the comments below, and I'll see you in the next dividend stock investing video.